Okay. All right, good. So this first question is really coming from chapter 14 because we didn't talk about convertible bonds. We didn't talk about bonds with detachable stock purchase warrants for the last exam. So I kind of, carried that over to this test. Okay, so we'll have questions from the end of chapter 14 on convertible bonds, bonds with detachable stock purchase warrants. Now, in this example, they talk about Blair Industry had outstanding $80 million of 8% convertible bonds that mature on June 30th, 2019. Interest is payable each year on June 30th and December 31st. The bonds are convertible into 6 million shares of $10 par common stock. And notice, guys, they do it on the same day. Okay, and the reason they do this on the same day is this problem doesn't want to make itself, a laboriously long problem. It's just a multiple choice question. In something like a free response, they might actually go ahead and say, well, some time has gone by. And if time has gone by, you're going to have to accrue interest and you're going to have to amortize, in this example, the discount, right? But in this case, since it was the next day, you don't have to do any of that. And the bonds, the discount on bond payable, they tell us is $4 million. On June 30, 2018, half the bonds are converted when Blair's common stock had a market price of $30 per share. When recording the conversion, and I had to type in for our wonderful textbook under the book value method, because they would have to tell you whether they want to use book value or what? Market value method, and they didn't say that in the question, and that was one finally that Arthur didn't have to catch for us, that they had as a problem in the book. I caught that they didn't call out book value or market value method. So I typed in under the book value method, because by the answer I could tell that's what they wanted to know. What should we credit, what Blair should credit to paid in capital in excess of par what? Okay. Now, when you look at the solution here, notice that because they have what? Cashed in half of the bonds and the bond payable total was $80 million, then if we're cashing in half the bonds, you're giving the bonds back to me and I'm going to go ahead and issue you the stock. So we have to take half the bonds off, right? Okay. Since we are turning in half the bonds, then we should take in half the discount. The discount was what? 4. A discount, of course, is going to be a debit when we issue the bonds. And so if we're taking the bonds off the books and we want to get rid of half of that discount, we should credit the discount, right, to get rid of it. Now, they issue the common stock at par, and they tell us it was what? 6 million shares of stock can be acquired for these bonds, and since they're cashing in half the bonds, then in effect we'll be able to issue what? Half of the stock. So if it's 6 million shares total, half of the 6 million shares would be 3 million shares of stock that is going to be issued here at par. $10 was the par value, the problem told us. So we just pick up that par value of $10. We issue the stock at par. And for the book value method, no gain or loss is going to be calculated, so we will simply do what? We will simply plug the APIC figure to make this journal entry balance, right? And that's the answer to this problem, $8 million for our additional paid in capital. Okay. Now, of course, if you wanted to not put this in journal entry format, it would be, of course, 40, what? Minus the 2, minus the 30 means at this point that there is only, what? Only 8 left to go towards the APIC. Okay. Now, when I looked at this, I thought, well, okay, if that's the case, and they were assuming, even though they didn't tell us the book value method, I had to write that in. What would happen if we tried to do this same problem now, and instead we're going to use the market value method? Now remember, market value method is something that is not acceptable for GAAP purposes, but I've seen lots of CPA exam questions and stuff where they do still expect you to understand how the market value method works, even though we wouldn't use it for GAAP purposes. Okay, so let's just go ahead and do the same problem now using the market value method. And what happens? Well, we will still go ahead and debit the bond payable for what? For the 40, because we're going to get rid of those bonds, right? They're still being cashed in. We still credit the discount for 2 because we're getting rid of those bonds, right? Now, what the market value method says is you still issue the common stock at par, and so that's still going to be what? 30. It's 30 million. It's the 6 million shares. 3 million shares. 6 million times the half shares. Half of the shares. That's going to be 30 million still, right? 6 million shares. And it's half of those that are being turned into stock. So it's what? That's 3 million times the $10 par. That's still 30 million, isn't it, to common stock? Guys? Okay, so I don't feel like I'm just sitting here talking to myself. So that's still 30 million, right? Okay, now what happens? Now we have to sit here and say, okay, what for the market, and this is where the market value method starts to become different than the book value method. For the market value method, we have to sit there and ask ourselves, well, what would happen if we had issued this common stock at its market price? Okay, so it's what? $30 per share is the market price, isn't it? So I would have taken the $30 minus the what? Par value of 10 means that they're issuing these 3 million shares now for what? $20 more per share. Okay, so if I do that, then I'm going to get what? I'm going to get 60 million as the APIC. So the credit to APIC now is no longer just the plug here. It's the what? Difference between the market value of the stock and the par of the stock, right? Okay, so I've got that 60 million that went to APIC, and then the gain or loss becomes the plug. So it's going to be what? Well, if I'm looking, I only have 40 over here. Meanwhile, I have what? I have 92 on this side. Okay, so what do I need? 52 is the loss. Okay, so notice that what? We still credit common stock, don't we, for the same amount? We still credit APIC, just like we did under the book value method, but now what? Now the credit to APIC is not just the amount to make the journal entry balance, it's the difference between the market value of the stock and the par of the stock, right? And then under the book value method, we recognize a gain or loss for the difference. Under the market value method, we recognize a gain or loss for the difference. Question? Okay, so you take a look then, they didn't ask us market value there. We take a look at number 2, and on March 31st, 2018, Ashley Inc. Bondholders exchanged their convertible bonds for common stock. The book value of these bonds on Ashley's books was less than the fair value, okay, but greater than the par value of the common stock issued. If Ashley used the book value method of accounting for the conversion, which of the following statements, what is the effect of this? And we know that what? We know that the shareholders' equity will be what? Increase, because we know that they have to do what? They have to issue the common stock, don't they? Okay, and they have to do what? They have to go ahead and, they have to issue the common stock. I mean, that's all I need to know here to answer this question. So the shareholders' equity will increase, right? Okay. Okay, come over and take a look at number 3. When outstanding bonds are converted into common stock, either under the book value method or the market value method, the same amount would be debited to what? We're still going to take the bond payable off. We're still going to take the premium off, and when you looked at that, it was the same amount, wasn't it? We got the 40 and the 2 for, in that case, it was a discount, but you still do the same thing to the bond and the related premium or discount, regardless of whether you're using book value or market value method, right? Okay. Okay. Well, they say that question's medium. Okay, that could be hard if you don't know what you're doing, I guess. Otherwise, it's medium because you don't have to make any calculations. Question on that? Okay, let's take a look at number 4 here. On April 1st, 2018, Austere Corporation issued $3 million of 10% bonds at 105. Each $1,000 bond was sold with 25 detachable warrants, each permitting the investor to purchase the common stock for $17. On that date, the market value of the common stock was $15 per share, and the market value of each warrant was $2. Austere should record the amount of proceeds from the bond issue to increase in liabilities. Now remember, when you have these questions, bonds with detachable stock purchase warrants, we talked about what? Your job as the accountant is to, of course, you know, they'll let you know what the amount of cash is that's coming in, and we have to do what? We have to sit here and figure out how much should go to the bonds, how much should go to the warrants, right? Okay, so how much do we want to go to the bonds? How much do we want to go to the warrants? And I want to get my cursor down here so it won't keep doing that jump up there. I guess I'm in the right place now. I don't know. We'll see. Okay, so the first thing to do is figure out, well, how much cash did I get here? And so if it's what? If it's $300,000 par on the bonds, and they issue it at 105, that means I take this $300,000 times 1.05, and so that's going to give me what? 315,000. Just doing the math on that. Okay, so I've got 315,000 of cash here. Now I have to figure out how much goes to the warrants, and this is the warrants only method because what? They tell me the market value of the warrants is what? $2. Now all I just have to figure out is how many warrants. Well, they tell me that it is $300,000 worth at par. Okay, they issue them at 105, so the par is 300. And what's the par of each bond? 30. So I mean 1,000, excuse me. So if I take 300,000 and I divide that by what? $1,000 per bond, that means that I have 300 bonds. I have 300 bonds, and if I have 300 bonds and how many warrants per bond? It is what, 25? 25 warrants per bond, so I take the 300 times the 25. That means that I have here 7,500 warrants, and then I'm just wrote that 2 down here, I guess. And I take that 7,500 times 2. That means that what? 15,000 should have gone to the warrants, right? Of the total cash. Right? So 15,000 goes to the warrants. That means there's only how much left to go to the bonds? 300,000, right? Okay, which was the answer to that question? Well, they say it's hard. I don't think it's hard. Okay. Okay, good. Let's take a look at this one now, number 5, and we've got again bonds with detachable stock purchase warrants. And this one, they want to know how much should go to, and I don't know why this file gave me a hard time. It kept wanting to bring amounts over in weird colors all of a sudden. I don't know, fonts. I was trying to fix as much of it as I could, but some of it I just said forget about it. So I don't know why that's blue. Anyway, so we have what? By what amount should the bond issue increase shareholders' equity? Well, we know that the warrant amount is going to be a credit to APIC warrants, right? Right? The amount that we attribute to the warrants, okay? And so we just have to figure out how much should go to the warrants. So they tell me that the warrants have a market price of what? $4 each. So all I have to figure out here is how many warrants, right? Okay. So if the bond issue is $1 million and we have what? 1,000 each. All right, divide that by the 1,000 bonds. That means that, by the $1,000 per bond, that means that I have what? 1,000 bonds, right? And they're giving me how many warrants per bond? 30? The heck did they put it? 30. Okay, there it is. 30, right? So it's 30 warrants per bond. That means we've got what? 30,000 warrants, and they told us already that the market price per per warrant was what? $4. So the answer is D. Okay.
I don't understand how it.
You don't understand how it answers the question?
I don't understand the question.
Okay. Well, let me show you the journal entry on this, and maybe that'll help clear it. Okay. So it's a credit to additional paid-in capital warrants. I'll show you the journal entry. Okay. So we've got cash, right? Did they show me the journal entry here? I don't think they did. No. Okay. So we've got what? We've got cash at what? 1 million times 103 is going to be 1 million. What? You guys are gonna have to help me because I didn't do these numbers. 1,030,000. Okay, thank you. So we got 1,030,000. That's the cash, right? And then I got to figure out how much goes to the bonds and how much goes to the warrants. Okay. So they come over and they've told me the answer to this question is that 120,000 is going to go to the warrants. And so you take the 1,030,000 minus the 120,000 number, please. 910? 910,000 is left to go to the bonds, right? Right? And so since the bonds have a face of 1 million, I know the thing wants to jump on me here. I'm trying to avoid that. 1 million, that means is the face of the bonds. That means that these bonds issued at a $90,000 discount. Am I doing my math right? Right? Okay. So now I know the discount, I know the face of the bonds, etc., right? So now all I have to do, I know the cash, so now I can just do the journal entry. Debit cash for what? 1,030,000. Debit the discount for 90,000. Credit the bond payable for the full million, right? We always put the discount at the full million. And I credit APIC warrants, which was the answer to that question, 120,000, right? APIC warrants is additional paid-in capital, right? is part of my stockholders' equity. So, I mean, all this question really was testing is if you understood that the amount that goes to the warrants is this APIC warrants amount, which is part of my stockholders' equity. Okay? Okay, number 6. Question on that? Okay, number 6, from the perspective of the, so that's it with the bonds with detachable stock purchase warrants and the convertible bonds. Just a few questions there, and I might put, I don't know, something like that, maybe 3 or 4 questions on the test. I'm not going to go hog wild with the questions on the test. How many multiple choice questions? 25? 25 multiple choice questions, 3 points each, and then a full response question, 25 points, just like we did last time, okay? Okay, so I'm not going to, if I only have 25 questions, I'm not going to blow a bunch of them on the end of chapter 4, okay? I'm thinking, 25 questions, multiple choice questions. I'm thinking, just for round number's sake, guys, and don't count the questions on the day they said, so wait a minute, you only said 5 and you gave us 6, or hey, you promised us 5 and you gave us 4, okay? I might, somewhere in this ballpark. Okay, but the back end of chapter 14, about 5 questions, that leaves us what? 20, okay? Chapter 17 on pensions, I'm thinking about 5 questions there. Again, I don't want to go too hog wild on that. That leaves us now 15 questions coming from leases and deferred taxes. And I'll probably split those up, 7, 8 to 7, 9 to 6, something like that. Probably the one that's going to get less coverage there is the one for which we end up putting the free response question from. And I'm thinking free response question will probably come from one of those 2 chapters, either leases, chapter 15, or deferred taxes, chapter 16. Okay? Okay, so you take a look, and we say that from the perspective of the lease leases maybe, and some of these questions, guys, are repeats of what was already in the homework, but I know there's been a while since we talked about some of that, and it's not like someone wakes up in the morning and says, what's the difference between a capital lease and an operating lease? So just to make sure that we kind of remember what we talked about, some of these you already saw in the previous quiz from this chapter. But from the perspective of the leasee, it's either a finance or an operating lease, right? Okay, from this perspective of the lessor, we either have an operating lease or a sales type lease is what we call the leases that deal with, that are like finance leases for the lessor now, right? Okay. Now, they don't say it here, but when we talk about sales type lease, remember there was a sales type lease in which we had only a financing profit, and then there was a sales type lease in which we had both the interest profit, the interest revenue profit, and what? And the profit that's generated from selling the equipment at more than it cost. Under the sales type lease, where it's just simply a straight interest revenue is the only revenue, we sell the equipment at our cost, right? And we just try to make the money on the financing. Okay. Then some of these questions are probably familiar because we're trying to remember what we talked about from chapter 14, some of the basics, okay? 15 now, some of the basics. One of the 5 criteria for a finance lease specify that the lease term be equal to or greater than, and it was the what? Major part of the remaining economic life. And I told you in the olden days, they used to call out to us 75%. Now they kind of leave it a little bit more open. But, when you start getting much over 60%, I think you can go ahead and start to say that's the a major part of the economic life. So you could always use that as a rule of thumb. Although as a practical matter, I'm not going to leave you guessing on any of the questions as to whether or not it's the major part. I'll use these terms, the major part of the remaining life. I'm not going to give you some numbers and make you calculate, is that the major part or not? Because they don't give us a a hard and fast number, and that to me means that the standard setters are telling companies to use their judgment, right? And it gets a little bit tough for me to, make you use judgment looking at a piece of paper in a classroom on a test, okay? So I'm not going to get into making you guess, but I may ask you, it's the major part of the remaining economic life, and then expect you to know that we've met the criteria for the finance. For the finance lease, sales type lease if you're the lessor. How many of these criteria do we have to meet? Just one, right? Just one. Okay. Coming down, one of the 5 criteria for a finance lease specifies that the present value of the lease payments be greater than or equal to what? Substantially all, right? Of the fair value. And as I told you, it used to be in the olden days, it was what? 90%. Now they have changed it to substantially all. Okay, and again, I'll use those words in a question. I will not ask you to, try to back into whether or not it's, the major life, the major portion, or substantially all. Okay, so what do we've got? We've got as criteria substantially all, right? And what was the other one? Major part. How many criteria were there? Huh? There was 4 total, right? Okay. What were the other 2? Other 2 was what? If there is an ownership transfer. I don't remember 4. What was the 5th one?
You have no use of it.
If you have what?
Like if it's special.
Oh, that's right. I forgot about that one. Thank you. Yeah, if it's made specially for us. That's right. Okay. That's correct. So we have that one too. So let me just go ahead and write those. Major part of life, ownership transfer. So we got 1, we've got 2, we've got what? 3, ownership transfer. Say it again. Bargain purchase. It's got to be a bargain, doesn't it? Okay, bargain purchase. And then 5, thanks Arthur, was the special construction, whatever. Okay, I forgot about that one because none of the questions ever asked that. Okay, but yeah, that's one of them too. Okay, so and at least none of the questions I picked out. So you have these 5 criteria. Now, if you have an ownership transfer or a bargain purchase, are you going to end up with that asset at the end? Are you going to end up with that asset at the end? Well, if it's an ownership transfer, then obviously they're transferring the asset to you. So you'll end up with it at the end, right? And if it's a bargain purchase, the presumption is that I'm going to exercise that option, right? Because it's a bargain. So, Arthur, the assumption is for both of those is that, yes, I will end up with the asset. And the reason I ask is what? When we have the financing leases, it gets a little confusing in that sometimes you'll see them amortize it over the term of the lease. Other times you see them amortize it over the life of the asset. Okay, and I don't know that we made this as clear as I would like when we first went through it, because I didn't realize that I didn't talk about this enough when some folks started asking me about questions. They're like, well, which am I supposed to use here? Okay, so what happens? If we have the ownership transfer, the bargain purchase, and I would say the special construction, because again, if they make this especially for me, you don't want it, so I'm probably the one that's going to end up with it, right? So if it's any of those 3, the ownership transfer, the bargain purchase, the special construction, then we should use what? We should use the life of the asset, right? Use the life of the asset, whatever the estimated life of the asset is, because we're going to end up with that, right? But if it's the major part of the life or the what? Substantially all the fair value, well, we're falling back to those, obviously, when we don't have the other 3 involved, right? And that's because the assumption is that we're not ending up with that. We're probably going to do what? Turn that asset back to the lessor at the end of this lease agreement. So if that's the case, then we should use what? We should use the term of the lease for our depreciation of the asset. Okay. Now again, this is what? This is our rule for finance lease. This is not our rule for operating leases. We get into a whole nother thing, right? Okay. Okay. Question on that? Okay. So we take a look and we say number 10, for the lessor to account for a sales type lease, the lease must meet what? There we go. They were even telling me right here. Any one of the, 5 criteria. You have to meet any one. And it's the same thing for the leasee, right? You only have to meet one of the 5. Okay, so all of that was just to sort of get us remembering, and I think, again, some of those questions were on the quiz as well, okay? That's just more or less, I'm not saying I'm going to give you a bunch of questions like that. That's more or less just for us to sit here and remember what we're supposed to do. And now I think, unless I accidentally pick the same question again, we should be seeing some new questions here in this practice midterm that'll apply some of those rules. Okay, so they want to know, first off, what amount of interest revenue should Smith Company report? Well, if it's interest revenue, Smith must be what? Must be the lessor here, right? Okay, so we have this equipment. It's a finance lease. Okay, so they just came right out and tell us. The present value of the lease payments are discounted 10%, was $80,000. The 10 annual lease payments of $12,000 are due on July 1st, 2018. So what happens? We have a payment that's going to go out at the beginning, don't we? And Smith had constructed the equipment recently for $66,000, and its retail fair value is $80,000, and that makes sense. If the present value of the lease payments are $80,000, then the fair value of the equipment should pretty much be $80,000, right? Okay. So what happens? We come over and we say, what's the interest revenue? Well, we have $80,000, and we made a first payment of how much? $12,000. All went towards principal, didn't it? So the carrying amount of the debt after that first payment is, what's that, $68,000? Okay, now they tell us that the interest rate is 10% on that. Okay, now an easy mistake to make on an exam, because this is a pretty easy question, and your instinct is going to be to just stop there, right? But because they purchased this asset on July 1st, and for 2018, we have only paid half a year's, or earned, since we're the seller in this question, half the year's interest, right? Okay, so you take that times the half, that's what, 3,400? Okay. Okay, good. Now, the next question.
I have a question.
Uh-huh.
I thought the whole 12,000 was against the principal.
It is.
Shouldn't be any interest, right?
Well, it was against principal. If we had purchased this at December 31st, you'd be right. But they purchased this at July 1st, so we had 6 months of interest that went by. I think in a lot of the problems, they were buying it on December 31st and making that first payment on December 31st. And so if they asked you what was the interest for year one, it would be 0 in that case, and the entire amount would go against principal. So the takeaway from that is you got to watch your dates, right? And once you look at this lease stuff a couple of times, it actually becomes pretty easy. And so the only way I'm going to make it worthy of your effort is maybe by putting some questions where they put the asset into use halfway through the year. Okay? Okay, good. So we come over, and they think that's a medium difficult question. I think it's kind of easy. But anyway, then we come over, and they say in the income statement, what should they report in connection with this lease? Well, we know they already have interest revenue of what? $3,400, don't they? Okay, but remember, when we deal with a sales type lease, it's not only the interest revenue, it's also what? The profit on the sale, right? Okay, so they said that well, we know that the sales price was $80,000 because that was the present value of the lease payments, right? So we have a sales price of $80,000, and if you look back at the problem, they told us that they produced this thing, and they constructed it at a cost of 66, right? So if you take the 80 minus the 66, so erase that line's in the way. Means we end up with, what's that, 14,000 of profit. 14,000 of profit plus the 3,400 interest that we'd seen from the previous problem means that we've got what, 17,400, which was C.
It's the fair value of the asset minus the
sales price minus the cost of whatever it was, cost of goods sold after we sell it, right? But in this question, Arthur, they tell us the fair value. Okay, I could have crossed this out, and you still should have been able to answer this because they tell me that the present value of the lease payments is $80,000. That is the sales price, right? The present value of the cash that I'm going to be getting for this is considered the sales price. So this question kind of helped you along a little bit. Theoretically, I could just not call out the fair value, and then you would have to know that the present value is the sales price. Okay. And they give us the journal entry here, which of course you didn't have to do the whole journal entry to know how to do this. And they're kind of, I guess this is useful right here though, that they're telling us what I just stated verbally, which is that the present value of the lease payments is the sales price. Theoretically, there really shouldn't be a difference between the present value and the sales price because, in the fair value. Because the presumption is someone doesn't pay a different amount than fair value, right? We assume that, we're not selling this to dope addicts, or we're not dope addicts. Hey, I need some money, just take it for less than its fair value, Or, hey, I need some equipment, man. Sell it to me for more than its fair value. I don't care. I just got to have this equipment. We assume rational minds, right, are making the decisions here. Okay. Let's go ahead and let's take a look at number 13. And, yeah, we did 12, right? So now it's 13. Okay. And when we look at 13 now, we've got this. This is now asking about is that Carla? Okay. They're asking here about Carla. Carla is what? Is the leasee, right? Okay. And just going back, they tell us that this was a what type of lease? This was a finance lease. So Carla's going to do what? She, I guess, is going to go ahead and have interest expense, and she's going to have to do what? Depreciate the asset, right? Since it's a finance lease. Okay, so you take a look, and I'm just going to go down to the solution here, just to avoid having to write it all out here. And if we are Carla now, there's her interest expense. Her interest expense is the other guy's interest revenue, right? Okay, and then the depreciation is, and in this one, you say, well, John, I thought we're supposed to use the expected life of the asset. Well, we are. Oh, no, we're not, because what? Well, they don't tell us why they don't call out and tell us why they came out as a financing lease, right? So even if they gave us the life of the asset, we wouldn't be able to know whether we should use the life of the asset or the term of the lease unless they called out to us the reason that we've treated this as a finance lease, right? So they wouldn't be able to give us two different periods to choose from, and so you'd have to use the only thing they give us, which is what? The term of the lease, which to me means, okay, they must have qualified for this lease either because of the substantially all or major part criteria, right? Or the, well, no, that's it. It would have to have been those two. It can't be the special because we're going to end up with it. But I don't know what the life of the asset is anyway. Okay? It should be rare that you would ever see a situation where the term of the lease is longer than the life of the asset. Why not? Why would the term of the lease likely not be longer than the life of the asset? That would be a horrible economic decision, wouldn't it? Let me see. Let me lease a piece of property that's going to be, fully depreciated in 5 years, and I'm still paying on it for 7 years. I mean, that would be ridiculous, right? So, again, that I just said, if it is what? Bargain purchase, ownership transfer, life of the asset. If it is the other three, then it's going to be what? Term of the lease, right?
No, here
And that's not the other three, the other two.
here the retail fair value is exactly the same as the new value of the lease payment.
Well, that's a good observation. However, just because the present value of the lease payments is exactly equal to the fair value of the property, that's a good observation. But the problem that I have there is that doesn't mean that there is not an ownership transfer that's written into the lease. And if it is, then we would use the, right? So they're not mutually exclusive, in other words. Because we only have to meet one of the criteria doesn't mean that we are not ever in a situation where we've met more than one. But that's a good observation. But I'm not going to have you guessing. I don't, the reason I don't like, Arthur, questions that get ambiguous about the facts as to whether it's one type of lease or the other, and that in the real world, you'd have the damn lease agreement in your hand, wouldn't you? And you would know what was in there and whether or not you met one of those criteria. But a lot of these questions written by whoever, right? And we've seen that sometimes they have problems in how they write these. They're looking for something to come up with. They start with a blank piece of paper, right? And they got to write a test question. So they start getting creative of things that they can test you on. Meanwhile, if you were actually doing this, that wouldn't be something that you'd have as a question in your mind. So I try to stay away from those kinds of sort of ambiguous about the fact pattern questions. Okay. So which one are we on now? 14? Okay, good. Caddy Solanas leased equipment from Smith on January 1st, 2018. It's an operating lease. The present value of the lease payments discounted 10% was $80,000. There's 10 annual lease payments of $12,000 are due each January 1st, beginning January 1st, 2018. The amortization of the right-to-use asset for reporting year-end December 31st, 2018. Now remember, guys, this is one of those areas where I told you, hey, FASB starts getting weird with what they have us do because they're trying to back into an outcome. They're trying to serve two different masters, in effect. And when they start trying to serve two different masters, we start having weird treatments of things, okay? So what's happening? They want to bring the liability on the books, don't they? Okay, they want to show that you're locked into this long-term lease agreement, and they want that to be on the balance sheet. But then they're turning around, they're saying, since you're not buying this property, it's not a finance lease, we're not going to make you depreciate it as though you own this asset, okay? And so what they're going to do is they're going to have us go ahead and debit what? Fair value use for $80,000. And what they were really interested in is getting us to put that liability. I don't know why I'm having to write liability next to it. I just want you to realize it's a liability. They're going to go ahead and they're going to credit the lease payable, aren't they? Okay, now FASB's objective was not to have this fair value use asset on the books. They don't care about that. They wanted this on the books. For operating leases previous to this, you didn't have to put a liability on the books. And so companies do what? FASB doesn't like when companies can, however they structure the transaction, will dictate the accounting. FASB doesn't like that because all I would do is make sure that I don't meet one of those stupid 5 criteria, and boom, I have an operating lease. I never have to put a liability on the books, right? So FASB came out and said, okay, even if you don't meet those criteria and it's an operating lease, we're still going to make you do what? Still make you put that liability on the books. The only time we don't put the liability is if it's a very short lease term, like 1 year. And that is what? Going to be incredibly rare. Who leases something for 1 year? I mean, why bother? You might as well rent it for 12 months and forget about it, right? Okay. So if it's 1 year, then they don't make us put a liability. You start to exceed that, now you're going to have to do what? Bring this payable on the books, which is what they've done. But now we have the problem that what? We've got this going on the balance sheet, but on the income statement, it seems a little unfair because in effect, I'm doing what? I'm sitting there and I'm going to have to depreciate an asset that I'm not going to really keep because we know it's an operating lease. So what they do is they have us depreciate the fair value use asset on the same schedule that we're amortizing, and I shouldn't say depreciate because we call them both amortizing. We're amortizing each of these on the same schedule, aren't we? So the what? The amortization for the fair value use asset will equal the amortization of the payable, right? Which, of course, is going to be the difference between the cash payments and any amount that goes towards interest, okay? So we go ahead here then with this, and they want to know what? The amortization of the right-to-use asset, and I would just focus on the liability because it's going to be equal to the amortization on the liability, which is what? 80,000, and they have annual lease payments of what? 12,000, and the first one comes out at the beginning. So that all goes towards principal, doesn't it? So that leaves us this 68,000 again. In love with this number today. 68,000. Okay, and the interest on that is what? 10%. So the amortization at December 31st, 2018, that means that liability sat there for a year, didn't it? Okay, so 6,800 is the interest. And if the actual payment is 12, then the amortization not only of the liability but also of the right to use asset is this 5,200, right? Question? That second payment did what? I mean, that first payment took off the principal, and then the thing sat there for a year. I'm going to make that second payment what? January 1st, 2019 here, right? But for 2018, I've had that outstanding for a full year. That's my interest expense. It's also my interest expense, my amortization. I'll just do the journal entry. Do they show me the journal entry down here? No, let's just do the journal entry. So on January 1st, now when I make the payment, well, that gets annoying. Well, that's okay. I just put it as a payable. So I have what? I have interest expense of what? 6,800. I have amortization of right to use on the asset. Now I'm going to mess myself up here. Yeah. Oh, actually, they show the whole amount as what? They show the whole amount as expense. is going to be 12,000, and the lease payment payable is going to be what, 12,000? Okay, and then they will have a debit to the liability, lease payable, for 12,000, and a credit to what? Right to use asset. Not 12,000, but what we say was 5,200. Okay, this gets a little confusing because the lease payment payable, because the payment's not going to be made what until the next year. If it was being made immediately, I could just credit cash for that. Okay. Okay, let's take a look at. Well, I'll tell you what, let's take a quick break because I need to take a break, and we're going kind of fast through this anyway. So we'll take a quick break, about 10 minutes, guys. We'll come back about 20 till, and then we'll wrap up these questions and go through the free response question, all right?